Okay, guys, recording merger acquisition for Finance 498 during the COVID-19 outbreak. So maybe very uncommon to talk about merger acquisition because companies will not talk about merger acquisition during this time period, but you never know, right? Especially acquisition. So if certain companies for too much, like Delta Airline, right? Stock price goes down so much. Warren Buffett bought some, and then he realized he did not see this before. So Delta Airline dropped another 30% after he bought it. Anyway, this is a really unique time. It doesn't mean that he didn't do it right. Many companies are in trouble. It doesn't mean like Marriott, right? Marriott is in trouble. It's on the news. They start to basically start to fire people. So that's the only thing they can do to to be survive. So let's talk about it. Okay. Let's just talk about what you need to know. Acquisition is one company buying only part of another company. Okay. Merger is acquire, absorb the entire target company. Acquire is initiator. Target is the opposite, right? The opposite side of the acquire. We have different forms of integration. Okay. So we have statutory merger. The acquiring company acquires all the target assets and liability. The target ceases to exist. Basically, take all the assets, assume all the liability. Subsidiary merger. Target company becomes a subsidiary of the purchaser. Is typical when the target has a well-known brand. So this is target company become. It's like can you guys think of any company? The American Airlines and American Airway probably be more like it, but it's a little bit different. It's not only one small division. They merge the name together. Consolidation. Both companies cease to so American Airlines and American Airways consolidation. Both companies cease to exist and form a new company. So you can think about it. I don't really have anything right now. Horizontal merger, two businesses in the same or similar industry, right? Competitors. Vertical merger, the acquiring company seeks to move up or down the product supply chain. Like ice cream manufacturer acquire a restaurant. Or Walmart acquire some like some farmer, right? Farmers market, probably like that. Or like Walmart start to make something. Amazon, you can see that they have Amazon. What is that called? Amazon Basics. Yes. So they have a brand called Amazon Basics, right? They probably just buy some company like I have a tripod, right? That is Amazon Basics. Amazon probably bought a tripod making manufacturer. Okay. It makes no sense for them to start from zero. It makes a lot of sense for them to buy a company making tripod and then rebrand it as Amazon Basics. Conglomerate merger. I can never say this correctly. To a company operating in a completely separate industry. It's like Coca-Cola or Apple bought Coca-Cola. If it ever happens, right? So those are some examples of the merger acquisition. It happens frequently. LinkedIn sold to Microsoft. So I can recall EMC, DirecTV. Yeah, they have quite a few going on. So let me just talk about this. Given that when you need to do your individual case, right, we rely on Bloomberg. However, now you cannot have access to it. So let's just focus on the idea, and then you have Morningstar Direct available for you. So when you do merger acquisition, you just need to have this in mind. I probably waive the Guru project for this, and be flexible on the individual submission. Okay. reducing cost or increasing revenue. The only reason why companies involved in merger acquisition behavior is because you will help them reduce cost or increasing revenue. Like American Airlines and American Airways, right? They merge together. Maybe they don't need enough people in the check-in, okay? So maybe they can reduce their staff to save some cost, right? Or when they are much larger, they have more airplanes. Maybe people were more likely to book from them because it's just more convenient. That will increase their revenue, right? Or achieve more rapid growth. Some industries are mature, okay? That's why you see big companies buy small companies all the time. And I think when companies are big, they got stuck with the size. They cannot be that innovative as compared with some smaller ones. That's why they buy small companies because of the growth. Increase market power, right? If two oil companies merge together, that certainly increases their market power. Gain access to unique capability. So if so certain business, you need to have enough capital to be able to do certain things. Like R&D can be very expensive for a small company. Size will help. Diversification. Some business, they want more business lines. It's a debatable topic. Amazon bought Whole Food, right? Also, it can help bootstrapping their earning per share. That's a math scam. Basically, when a company with high PE ratio or low earning per share or earning yield bought a small company with high earning yield, their earning per share can be high if the company was bought using stocks. And also it has personal benefits for managers. Because the larger the company, the more powerful the manager is, right? Tax benefit. Some are merged just because of tax benefits. So this is accounting, right? And unlock hidden values. So some small business might have a really good idea. However, they cannot make it happen because of other limitations. That's why through merger acquisition, a big company can come to help. Or like you see those in venture capital and private equity all the time. Okay, so those capital comes in and then take over the management to unlock the hidden value and then sell it. So that's what that is. Or it might be because of international business goals. Like Autodon, I remember that case. Autodon was buying companies in Brazil, South America. They don't want to open a new store; they just buy some repair stores. Economics of scale, right? So you learn this from econ. A larger firm may be able to reduce its per unit cost by using excess capacity or spreading fixed costs across more units. So the larger, the less fixed cost per unit. So this is called economics of scale. Some vertical integration will help you reduce uncertainty. How would I say it? You can see it every day. Okay, let's talk about what's going on those days with the coronavirus or COVID-19. So some companies cannot have enough inputs because China shuts down, right? A lot of inputs in many ways are from China, and then because Chinese government, you guys need to differentiate China versus Chinese government. Okay, you cannot say the Chinese government does not really stand for Chinese people. They are very different. Inputs, okay. Those inputs are from China, right? And then because of that, they cannot have enough inputs. They cannot produce anymore. That's one example. Okay, so that's why sometimes if you, like I think after this, okay, United States will probably move many companies back to the U.S. or they will move back because of bad experience with disruption of supply chain and political issues. But you don't want to do too much of those. You need to know that this is a perfect competitive market. Those economists think vertical integration is not a good idea because you can get it cheaper from other places. Like United States can buy things cheaper from China in a perfect world, okay, and everyone will be good. However, the world is not perfect. We have a lot of issues. We had a trade war, we had a coronavirus, and then there are many other issues, right? So that's why you will see that you have more and more vertical integration. Though I think in the next 5 years for big U.S. companies, you will see more and more of it. I feel like the globalization will be gone very soon. But you get the idea, okay? So probably you will have vertical integration within the United States. You will see many small companies in the U.S. like Apple, right? Let's say the big company is Apple. Right now, many of the suppliers are from Taiwan and China. I think you will see those decrease, and then you will be replaced with U.S. small companies very quickly. Why? Because of national security and many other concerns. Even though those can be a little bit more expensive, okay. However, I think that's where the world is going those days. And then those are the suppliers, right? When we talk about integration, those small suppliers belong to the big company. Apple will probably start its own manufacturing. I don't think that will happen anytime soon, but I can see that those companies will be different. They will be from the U.S. companies. So when you have two companies, that can be a really good match. They can also merge, right? So let's say, hold about, give an example, missing pieces, right? You can see the missing pieces. I can see that Tesla with autopilot might be merging with some camera producers soon, or some software company. Elimination of inefficiency. Yeah, poor management may waste money, make poor decisions, right? However, after you merge it, so when company A and B merge, okay, when they merge with each other, the management, one of the management will be gone. That's why managers don't like merge acquisition. Okay, many companies. I was at TD Ameritrade conference. No, it's not TD conference. July. Okay, Nasdaq. I'm talking about the Nasdaq Stock Exchange location in Times Square. Okay, we won the grant from TD Bank, right? Their CEO resigned the night before he talked to me, to us, because Dr. Gibson, me, and some other schools were there. The CEO resigned. Why? At that time, we didn't tell anything because it's July 2019. That was a good time, okay, everything is good. Cannot believe, right, within 6 months, everything can be so upside down. Yeah, he resigned. He didn't tell us why, and then until February, I think, February 2020, when I was at San Diego, okay, attending a conference. Oh, is that February? Schwab. No, it's November 2019, okay. 4 months later, okay, and then we know why, because TD Bank will merge into Charles Schwab. That's why he resigned. He does not like it. And he will lose his job anyway. Okay, whenever two companies merge together, one of the CEO will be gone. That's very likely. Okay. So you can see that, right? When management will be gone, and then maybe it's not efficient. Sometimes the only way to redeem the situation to change management. Remember, managers, okay? Managers don't own a company. You own the company. Shareholders do. So investors are the owners. You hire them. Okay, you can fire them anytime. So don't feel bad about CEO getting resigned. He got fired. Okay, if you think back, he's not resigned. He got fired. It just sounds better when someone resigns. Okay. Economic gain. Economic gain. Basically, after you have a merge acquisition, right? You can either reduce cost or increase your revenue. So that means you have a higher cash flow from the future. So when you discount it by a discount rate, that's why you have economic gain. You need to know that this is finance, in my opinion. That's why it makes no sense to see why the U.S. market or global market was down like 30%. Today is March 23rd, right? 2020. I think this is from February 20. Within 1 month, okay, the global market was down 30%. Almost no country can be exempted from this. Everything's down. But it makes no sense if you think about how we calculated the price. Okay, remember the price is 0, 1, 2, 3, 4, right? Years. Okay, how many years we have in the future, right? What do we have on the timeline? Dollar amount, cash flow, right? So do you guys think the coronavirus will be here 1 year later? Probably, yeah. Let's just say it will stay here 1 year later. We lose the money here, right? It goes to 0. Let me just say it will stay for 2 years, which is very unlikely because the vaccine will come out within a year. We don't really lose any money here, okay? So if the future cash flow is not impacted, how come you lose 30% of the value? The only reason is panic. People don't like it. People are humans. We like to be panicking. I think that's the only reason to explain. That's why it's a good time to buy stocks. Probably this will probably stay here anyway. So we will see how that goes. You need to know this is finance, okay? As a financial analyst, you need to pay attention to this. This is the core of finance, okay? So let's talk about the example. We have two companies, right? And then they combine together. So basically, they have a high revenue because the business is larger, getting easier for people to find. They have high revenue, and then their cost goes down, okay? Like if you add those, it should be 134, right? However, it goes down to 2 because maybe they cut several people out. Maybe they fired one company CEO, okay? And then you can see the earning, right? The earning originally was 36, and then now you have 40, so you have $4 additional, right? If you assume a 20% cost of funds, then the economic gain is this. You assume that you make $4 additional, right? 3, 4, $4 additional forever, right? This is a perpetuity. That's how you calculate the present value of a perpetuity. Okay? Merger are used for surplus fund. If your firm is in a mature industry with few, if any, positive net present value projects available, acquisition may be the best use of your fund. So what it says is, look, if you have no way to invest, if you find no other opportunities, then just acquire a new company. I can talk about Warren Buffett, right? So he was doing texture companies a long time ago, right? Cotton related. And then later they find no place to grow, so they bought an insurance company. You guys see that? So in Rock here, okay, just south of Winthrop, you can see You can see some, is that Rocky or Cotton? Yeah, I think it was probably a really successful business maybe 50 years ago. But no, they don't do well, right? So that's why when you find no positive net present value projects available, you probably should buy a new industry, okay? Because things are changing. So you can bootstrap your earning per share if you involve in merger acquisition. You need to satisfy certain conditions. Acquiring firm, you need to have a high PE ratio. Right? We don't like high PE ratio. That means the stock price is high without relative earning. And then you need to selling firm, the target firm need to have a low PE ratio. Okay. After merger, acquiring firm has short-term earning per share rise. Okay. Long-term acquired will have slower than normal earning per share growth due to share dilution. This is one example. Okay, this is how you bootstrapping earning per share. So this is what enterprise is, right? Before merger, earning per share is $2, price per share is 40, PE ratio is 20. We have number per shares, total earnings, total market value, and then current earning per dollar invested. This is earning per share, right? And then this is a relatively smaller company, right? Earning per share is $2, price per share is only 20. The PE ratio is much smaller, right? This is good, okay? And then number of shares, right? Everything else is very similar. Remember the earning per share or earning yield. A lot of times I would like to think about it as earning yield. It's the same. You just reverse earning per share. You just reverse PE ratio, that would be earning yield. Okay. So basically, this company is really profitable. Can I see that? So look, you have 10 cents with $10, right? And then right here, you have only 5 cents with $20. No, price, $40, okay? $40 make you only 5 cents, and then this company $20 make you 10 cents. Certainly, this is more profitable, right? You guys can see it. A less profitable company buys a more profitable company in terms of earning yield will make the company look. Okay, this again look more profitable in the short term. You need to know that you need to exchange stocks. You cannot pay cash or anything. Okay? Basically, look, you have $20 per share, right? You have 100,000 shares, and then my stock is $40 a share. Okay, let me just give you 1 share. You give me back 2 shares. Is that making sense? So we have $20 a share, right? So let's say you own this company. Okay, you own this company. Okay. Then I own this, right? I own this company. I give you 1 share. So it's $40, right? You give me 2 shares back. Is that making sense? Because each share is $20, okay? I give you 40, you give me $20 back. And then this will reduce the share to 50,000. Okay, that's where the game is. Okay, that's why your total number of shares will go down. You guys see that? Stock price will come to the original or acquired stock price. And then you can see you need to have the total earnings here, and then you need to come up with this number first, because the earnings will not be impacted by the merger acquisition. You have $200,000 adding together will be $400,000, and then you have only 150,000 shares, right? So that's why your earning per share is $2.67. Okay, that's why you can calculate your PE ratio, and then you can calculate your earning per share. So take some time, given that this is a video, okay? Take some time to try to understand this. If not, that's fine. This is just a game, okay? You just need to remember that they can do it this way. Can you observe this? In reality, yes, but is it going to be as clear as this? No, because there are a lot of noise. Stock price changing every day. This will not stay at 40. it makes sense, right? A less profitable company bought a more profitable company. In the short term, this company may look to be more profitable if they didn't pay any money for it, they just use stock to exchange for the ownership. That's what it says, okay? And then also you need to know that the main reason is because reduce of number of shares, okay? Reduction of number of shares. Because look, if the number of shares does not change, then you can see if this is 200 and then this 400 divided by 200, it will be still 2. Okay, so you will not change. The main reason is because they are either reducing or number of shares here. This is another example. Stock price, you can still see, right? That's what it looks like. Again, smaller number of shares. Okay. Merger acquisition, merger and the industrial life cycle. Okay. I think this is from CFA curriculum. I just put it here. Do they test it? No, but it will help you understand it. Let's just go over pioneering development. Industry exhibits substantial development costs and has low but slowly increasing sales growth. Younger, smaller companies may sell themselves to a larger company in mature or decline industries and look for ways to enter into a new growth industry. Young companies may look to merge with companies that allow them to pool management and capital resources. Right, this is different stages. Okay. Then we have rapid acceleration, mature growth, stabilization, and market maturity, deceleration of growth and decline. So you guys can just take a look. Stock purchases acquire give the target company's shareholders some combination of cash and securities in exchange of the shares of the target company's stock. Must be approved by at least 50% of the target company's shareholders. Can be difficult and time-consuming to win shareholders' approval. Okay. So basically, this is very common. Okay. Acquire give the target company share a combination of cash and security. So you need to get that company right. What is the way to control another company or buy another company? You just buy all their shares. Is that making sense? But how do you pay for it? You can give them cash. Tell them, look, I want to buy your shares. Here's the money. Okay, that's one way. And some people don't like it. Some people say, I don't want to sell my stocks. I don't want cash because if I have cash, I still need to find out what to buy, right? He said, what about this? I will give you some of the stock of myself, like Amazon, right? Amazon says, I want to buy this company. Can you guys sell it? They say, oh, yeah, we are fine selling it, but we want to exchange for Amazon stock. Is that making sense? Why? Because they stay positive about the company. It must be approved by at least 50% of the target company's shareholders. Can be difficult and time-consuming to win shareholders' approval. This is stock purchase, just buy their stocks. Asset purchase, purchase the target company's asset, and payment is made directly to the target company. Basically, you buy everything they own. Okay, can be done quickly and easily. You don't need to talk to their shareholders. Management can make that decision. Can buy only parts of a company of interest. Yes, this is very true. You cannot buy all their assets, right? So like IBM has the PC business, okay? If you buy everything or all assets on that PC business, you own that company, right? You buy all their factory, all the equipment, okay? You get all the employees or human capital, then you own that company. So this is another summary of the difference between stock versus asset purchases. Target shareholder receive compensation in exchange for their shareholder approval required, no corporate level taxes. Target company shareholder are taxed on their capital gains. So basically you sold it, right? That's why you have to pay tax. Acquire, assume the target's liability. So you own the company, you assume their liability. Asset purchase is very different. Payment is made directly to selling company rather than directly to the shareholder. Basically you just let's say Tesla has a factory, they just have to sell the factory. That's all it is. Okay. So shareholder approval might not be required. So when you just sell equipment, maybe they don't need to approve it. Target company pay taxes on any capital gain. Again, if you sold some assets, right? If you have any gains, then you need to pay tax. No direct tax consequence for target company shareholders. Now, if you make a profit, it will be a company's earnings, and then if it's earning, right, they pay you dividend, then you need to pay. But just selling the asset itself will not have any implication for shareholders regarding tax. Acquirers generally avoid assumption of liability. You just buy their company. You don't need to worry about the liability. They cannot even use the other collateral, right, to make sure that it's a clean title, basically, when you pay full price for it. Method of payment. Security offering, target shareholder receive shares of the acquirer's common stock in exchange for their shares in the target company. The number of the acquired shares received for each target company share is based on the exchange ratio. What is the exchange ratio? 2 to 1, right? 2 to 1 ratio. It's like for 2 shares, like, do you guys remember you have $20 per share and then I have $40 per share? That's a 2 to 1 ratio. So basically, for 2 shares, each 2 shares you have, I give you 1 share. So that's what exchange ratio is. Is this ratio given, or like you can calculate it? Because in the previous example we have 20/40, right? 2 to 1 is very clear, but in reality, no, it's negotiated. The current stock price will have some play in this negotiation. They can either be nicer to you or give you some premium, or not that nice to the acquirer, okay? Or basically discount. Depends on the negotiation. Many times it's just mix. A lot of companies, when they do merger acquisition, it's a mix of cash and security offering. Okay? This is important. Which payment method to choose? Okay, because it has different risk and the reward, risk return. Okay, it's very nice to talk about this, to remind you guys again about risk and return with COVID-19. Okay, the global market is down. This is a great time to think about the risk strategy you have. Again, okay, you can make a lot of money sometimes by taking a lot of risk, but when things like this happen, you can kill yourself as a company or an investor. Okay, so that's why risk management is extremely important. Okay? So that's why in the merger acquisition transactions, we need to understand the risk and return related to this. In the stock offering, basically, like if you have a small company, Amazon buys you on Amazon stocks, okay, then you become Amazon stocks, right? You become Amazon shareholders. So you need to basically you need to take the risk of Amazon. Amazon is doing great, then you are good. However, if Amazon is doing not that good, you lose money. That's your risk, right? However, if you take cash, you are out. You have nothing to do with you anymore, right? You sold your company to Amazon for cash, then you don't need to worry about it. You have cash. So you guys see that? So when you take cash, you believe that Amazon will not do well in the future after bought your company. Maybe they pay too much. Maybe you just think people will not like to shop over there anymore. Okay. However, if you say I want some stocks, you think they're gonna do great in the future. Okay. Relative valuation of company involved. If acquired shares are considered overvalued by the market, the acquirer is likely to use its overpriced share as the currency in the merging transaction. Basically, if let's say Amazon has a really high stock price, then very likely they're gonna say, I'm gonna just do security offering because it's just cheaper for the overpriced shares. Okay. In fact, investors sometimes interpret a stock offering as a signal that the acquired share may be overvalued. You guys see that? So basically, the only reason why they like to give you stocks to exchange for your stock is because they think it's too expensive. It's a really easy way for them. And then certainly has changing capital structure, right? different payment structures have an impact on the acquiring firm's capital structure. If the acquirer borrows money to raise cash for a cash offering, the associated debt will increase the acquirer's financial leverage and risk. So companies can borrow money. Companies can borrow money to buy company, right? Issuing stock for securities offering can dilute. Sorry, my kids were here. Issuing new stocks for security offering can dilute the ownership interest for the acquired existing shareholders. So remember, in the previous example, right, you need to give them 50,000 more shares. So that will certainly dilute the current existing shareholders' position. Why? Like, if you have 100 shares, right, and then you have another 50 shares, okay, so you have 150 shares, right? So if I have 10 shares, originally I have 10%, right? And then now if I have only 10 shares, and then it has less than 10%. That making sense? That's what I have around 7%, right? 7% ownership. So my share got diluted if I don't buy any shares. If I keep like the number 10. So this is one example. We have cash purchase and then exchange of shares. We have one company, originally it's 480, and then this different company, right? Economic gain is $20, and then cash paid, right? You cash paid to the shareholders. So this is subtracted because it's assets. Okay, if you give them cash, then the money is out of the company. That's why the value goes down here, right? Share outstanding post merger, because the share does not change, right? If you have 10 shares, then you still have 10 shares. Okay, and then the price per share would be like this. Okay, and right here, if you pay them, this is a little bit different. Okay, you can see if you don't pay any cash, however, you just use stocks, you give them 0.833 shares for the company, then your number of shares goes up, right? So that's why your price per share becomes this. Okay. Again, this number, I think right here is calculated based on like this, divide by that. You don't have to. A lot of those are negotiated. Okay, and then stock price change every day. Then we can see that from this merger, there are, because look, you have let's say through this transaction you made $10, right? $8 become to the acquirer, and then $2 become to the target. You have two people working on a business together, they make $10 more, right? The next part, try to figure out for the additional $10 we make, where did it go, right? Did it go to you, or did it come to me? Did it go to the acquirer, or did it go to the target? So we can see that the value of original, so this is acquired shareholder, right? This is, if you pay cash, that's how much, right? And then you have only, originally the value is 480, okay? So that's how much you make, 12.5, okay? For the acquirer, in total, right, economic gain from the merger is, this is $20, right? $12.5 goes to the acquirer, and then the 7.5 goes to the target. That's how it is calculated. It is the same here. The value of this acquirer is 49.85. Remember, they have only 10 shares. That's the original shareholder. So that's their new value, and then that's how much it was, and then that's their gain, and then the remaining is belong to the acquirer. When I was talking a while ago, you would think a merger acquisition is good for everyone, right? But sometimes not. We were talking about friendly merger offers. So when basically you have someone who you like, and then you do business together, it's called a friendly merger, right? And then we have a hostile merger offers. So basically, target company's management does not support the deal. acquire, submit a merger proposal directly to the target's board of directors. Okay, so those are like CEOs, right? They think, oh, that's not a good idea. Remember, they are not the owners. So the buyer can go directly to the board of directors. Who is board of directors? That's basically shareholders representative. This is called a bear hug. Why it's called it? They go over, right? Maybe it's a bear that is so big that it can go over management directly to shareholders or board of directors. But board of directors might not approve it because they probably agree with the management that's not a good idea. What can they do? They can do something else, right? Remember who's the owner? Shareholders. They can go directly to the shareholders to do a tender offer. So acquire offers to buy shares directly from the target shareholders. Okay. Or do they do proxy battle? Acquire. I think I type it. Majority of these are from CFA level 2 curriculum. This is important for the exam, and it's so look. Let me just be honest with you. I think the job market is gonna suck in the summer. Okay. However, in the fall, it will recover. Okay. So you wouldn't think that maybe it's not making sense to learn anymore because probably we don't have a lot of jobs in finance at this time, but we have no job in anywhere. Okay, companies are going to freeze their hiring very soon. However, after this virus, COVID-19 is over, they're gonna need to hire again, and that's when you need to. That's why you need to start it now to be prepared. Seeks to control the target by having shareholder approve a new approve the board of directors. So remember, the board of directors are a representative of shareholders, right? So those shareholders can choose to get a more friendly board of directors to the acquire. We have poison pill, pre-offer defense mechanism. Okay, so if you have a company, right, and then you worry that in the future someone is going to take advantage of the company when it is not doing all right. Maybe it is totally okay to sell the company as soon as the price is right. However, like things can change, right? Like American Airlines, the price. Or all airline companies. I wouldn't think about one company at this time. Their operations suck, right? Because there's no flights anywhere. They cancel all the flights, even domestically, few people fly. And then what if there's a company that is going to buy American Airlines at this price? It's really cheap. Are you going to sell it? You might not be a good idea to sell the whole company because you know it's going to recover, right? So that's why sometimes you can have some defense mechanisms available. I'm not talking about American Airlines, so I'm just giving you guys an example. I think the federal government will bail them out. Give current shareholders the right to purchase additional share stock at extremely attractive price to cause dilution of the acquired. So what does that mean? So let's say we have $10. The current stock price is $10. We have 100 shares, right? So let's say the acquirer want to get 50%, right? So the acquirer bought 50 shares, right? 50 shares already. So that makes their ownership price, like ownership proportion above 50%, right? And then that will trigger those poisoning pill mechanism. It's like you shot a gun, the bullet is coming out, okay? What will you say? As soon as this happens, it will trigger an event. All current shareholder. So we have 50, right? 50 stocks can buy like 10 shares at only $1 per share. Is that making sense? This is written previously in legal document. So because it's $1, right? This $10. Of course, people are going to buy it, and then with those people, we have another 500 shares created. Now, how many shares do we have? We have 50, right? 500. We have 550 shares now, and then they have only 50 shares. That's like 10%. You guys see that? They paid a lot of money. However, because of this poisoning pill, they get only 10%. They're not gonna even touch it, okay? As soon as you have the poisoning pill in place, okay, it's like a pill pre-offer. Before that happens, you have that in place. If you have that in place, they're gonna forget about it. Nobody will try to acquire, or at least try to acquire a company in an unfriendly way. They will probably talk with the shareholders and then make sure it's a friendly acquire. Okay. Because this is crazy, right? They spend so much money and then you get diluted so much, they get only 10% versus 50% just because of this one defense mechanism. So same poison purge, it focuses on bondholders. It gives bondholders the option to demand immediate repayments of bonds that will create additional cash burden for the company. So as soon as you have someone with 50% ownership, and then this will kick in, all bond shareholders can ask for their principal back. So basically you can get a company, 50% ownership, and then tomorrow it can go bankruptcy because you don't have a lot of cash in hand, right? And then certainly they have state and federal laws that are restrictive takeovers. And then they regarding the board of directors, right, they can have different terms to make sure that the bidder can only win 1/3 of the board seats. It takes longer and harder to acquire a company. All those are defensive mechanisms. And also they have something called restricted voting rights. So basically, a lot of times you need to have certain percentage of people of shareholders approve, right? So ownership above some threshold, like 15%, triggers a loss of voting rights unless approved by the board of directors. So like you can own a lot of shares, but you will lose the only voting rights, which means you have no control of the company. Or they can pass something called a super majority voting provision for mergers. So like previously only required 50% approval because this is a merger, right? Maybe they have an additional provision requiring 80% for that to be approved. And they have a fair price amendment. They have a way to determine what is a fair price, okay, from an independent appraiser. Again, it is totally okay to sell a company as soon as it is fair, okay. Golden parachutes is a compensation agreement between the target and the senior management if they leave the target company after a merger. In reality, usually not big enough. Managers do not concern about losing their jobs. Remember, managers a lot of times don't want the company to be merged, right? Because they lose their jobs. Well, what if you offer them good benefits like 2-year salary? Maybe it's better, right? Post offer defense mechanism. So if let's say you have a company, then someone make an offer already, what can you do? Just say no. I don't want to sell it. What if they buy from other shareholders? Like you have 2 friends working together, right? You 3 own the business. What if they buy from 2 other friends? You sue them. Okay, you file a lawsuit against the acquirer. Okay, why? As soon as you file a lawsuit against the acquirer or the company who is trying to buy a business, they cannot do it anymore until the lawsuit is resolved. It makes it more time consuming. Okay, so then you have lawsuits involved, right? When you have more time, it may give you some time to negotiate, then try to find some other friend who's going to help you, right? Greenmail a payoff to the potential acquirer to terminate the hostile takeover attempts. So basically, a hostile takeover, they are here for money. It's like a robbery, okay? So just give them money and then they will leave. I don't know how well it will work. Historically, it happened. That's why we have this. Share repurchases, use leverage, control company, and add more risk to the business that will make it less attractive. The only reason why they like to buy a business is maybe your business is so good, right? What if you increase your leverage, then add more risk to the business, which might be above the risk level they have because those acquire, they have their own internal risk control, right? So they have to get approved internally too. And then leverage recapitalization, target assume a large amount of debt to finance share repurchase. Again, it's very similar. Crown jewelry defense. Target may decide to sell a subsidiary or major asset to a neutral third party. The court may declare the strategy to be illegal. Basically, if you have a good business and then they want to buy your business, you just pick the best part of your business and sold it separately before selling the remaining to the acquirer. That's why the court might declare it illegal. Okay, it's like you have a lot of money and then you intentionally transfer your money to some other people so that you qualify for Medicaid. It's the same idea. Okay. Pac-Man defense, the target makes a counter offer to acquire the acquirer. It's like, if you know what Pac-Man is, right? You know what it means, right? It just eats many things and then you eat back, right? White Knight defense, a friend come to help you. White Squirrel defense, or Junior Knight. It's not as strong as a White Knight, but it is still a friend of you. Target 6, a friendly third party that buys a minority stake in the target without buying the entire company. The stake needs to be big enough to block the hostile acquirer from gaining enough shares. I think I hand wrote this a while ago. This is a squirrel. Okay, squirrel like a little rat. A white squirrel defense. Okay, it is very interesting. Leverage buyouts. Okay, a large portion of buyout financed by debt. What is that? So basically, you guys know what leverage is. Leverage means you use debt, financed by debt. Buyout means you buy some part of the company out, or you just buy a whole company out. A lot of times from management. Let me talk about management buyout. That's what I'm familiar with. Let's say you have a company, right? Let's say Tesla. Tesla stock is going down just like everything else. It's like $400 a share. The managers know more about the business, right? What is good about Tesla? Their autopilot, right? So autopilot comes from one division, right? What if the manager of autopilot and then the team decide they want to leave the company? However, they want to buy like all the current technology and take it with them to become a separate company. They can do it because that's what they developed, right? And then they know what they are doing. And then the small company can be very promising if they just focusing on autopilot and then make that available to all other car companies. And then some capital will be interested, right? Some fund manager or like private capital, private equity will be really interested, or Wall Street will be really interested. However, they say we don't want to give you any ownership. We just want to borrow money from you. So let's say it's like $10 billion, right, value of the autopilot, and then the manager just borrow $10 billion. The manager will form a new company, and then the new company will borrow $10 billion to buy from Tesla the autopilot. So that's what management buyout is. So managers know what they are doing. Or acquisition of the firm by a private group using substantial. Again, it's also leverage. It can be a private group. Okay, buy from a company. It's not a manager, just any private group. Potential source for value. So it can be some values in leverage buyouts. And then where do they raise money? They can just go to the junk bond market, leverage and taxes. They can go to other stakeholders. It has some. It is leverage, however, they have incentives, especially if you think about manager buyouts, right? Those managers know what they are doing. They have, it's a really leveraged position. They don't make any money unless they did a great job. So they're going to work like 24 hours, 7 days, every day, so that they get paid. And then the issue is they might not have any free cash flow soon. Okay. So a company, so let's say we have a divestiture when a firm sells some of the asset to another entity as a going concern. And then So all those are different types of, how would I say it, different types of dividing a company into small pieces in a way that can be useful or in a way that can be beneficial, either from a tax perspective or from other ways. Like, let's just go over this, and I will talk about some other things I'm more familiar with. Spin off, right? The process of a business, separating the ongoing operation of a unit of that business and giving the shareholders of the parent company shares of the unit. Basically, you have a big company, right? And then you have a small one. So originally it was from here, and then you just move it here, okay? It's a separate one. And then some people, they have the same shares, okay? Same shares. And then this is kind of going around it, right? You see that? It's just operated separately to be more efficient. And this is used very, very commonly before the 2009 financial crisis. 2020 financial recession, I have a name already. It's very different. This is from a coronavirus. This is because they did something like this. They carve out, they spin off a small entity, and then the law treat it as a separate entity. They receive AAA ratings, which shouldn't, but they do, and then they can do many things with their AAA ratings. Carve out, similar to spin off, but the carve out issue shares of the new firm to the public. This is different, okay? So let's say you have this, right, and then you have this. This is separate. This is called a true separate. And they have their own shares. Okay, why they do it? Again, a large company can have a lot of issues, right? When, how would I say it? You ever work with people in teams? If you have 10 people in a team, is that efficient? It's not a good idea. Probably it's a good idea to pull 3 people into a small team, right? And then they can operate more efficiently. That's what it is, in my opinion. Okay, discounted free cash flow. How can you value a target company? So basically, so you want to buy a company, right? This is what CFA is tested really heavily. Remember, CFA is all about valuation, okay, about the price. Okay. So how much should I pay for this company? You use discounted free cash flow method, and then you compare the company you want to buy with some other similar competitor to see how much it is. And then compare transactions, right? You want to buy a company, and then you can see recent transactions, how many do they pay for buying a company. I had handouts from CFA Institute a while ago. Let me see whether I can find it and post it for educational purpose only. Okay. Or if you have a CFA textbook, I think this is CFA level 2. This is not going to be required for my class. So in your CFA curriculum, okay, you should be able to find those different ways of calculating a target company. They don't really test it because it's really hard to test it in the exam. However, it's going to be very useful for you from a practical standpoint to have experience valuing a target company. That's all I have for merger acquisition. I hope this is useful and helpful. Let me know if you have any